Good morning, Dr. Michael and Dr. Salawati. I'm Stacy and my group members are Nurul Ainsha and Tiffany Ibu. Company that we choose for our group assignments are Panasonic and Kin. I will present the introduction and the common size balance sheet and the conclusions. Kin was established by Chen Kin-fa in Senkinchan, 1961. Its commercial activity have been in the Middle East and African markets in Malaysia, Singapore, Hong Kong, Fujian in China, and Dubai. Panasonic Holding was established by Dato Sri Chiu Wen Ka before the beginning of Panasonic Holdings in 1965. A company called Kit Radio and Electrical Company was founded. Common size or vertical analysis is the method of measuring financial information by expressing its item in the financial statement as a percentage of the best sum over the same period of time. This report can be used by a corporation on its balance sheet or on its income statement. The common size balance sheet of Panasonic, the long-term debt average 11% of the total asset over the 5-year period, and that is a fair amount. It is also more responsible to consider that the cash represents about 12% of assets and the short-term debt account for between 25% and 32% of total assets over the last 5 years. Meanwhile, for the common size balance sheet of Kin, the long-term debt averaged 40% of total assets over the 5-year period, and that is a fair amount. It is also more reasonable to consider that the cash represents about 50% of assets and the short-term debt accounts for between 16% and 21% of total assets over the last 5 years.
Okay, first and foremost, I'm Nurul Ainsha. I will present the part of liquidity ratio and profitability ratio. Okay, for the liquidity ratio, it is the term liquidity itself characterized in accounting as a company's ability to satisfy its financial obligations. It is used to actually to determine the willingness of a company to cover short-term debts and to indicate the company's resources to pay on schedule to its customers and creditors. However, for the current under um, under liquidity ratio, there are two ratio, which is current ratio and quick ratio. For the current ratio, it is the current business ratio for both company is more than once, since the company successfully uses the current asset or its short-term lending facilities. Since both facilities have a ratio greater than 1, the company is the good company, because the higher the ratio, the better the company's financial condition. The Kin's current ratio is higher than Panasonic because Kin's current assets are higher than Panasonic, such as cash, bank statement, trade receivables, and inventories. However, for the quick ratio, actually it is more conservative than the current ratio. Okay, for example, the company of Kin display a ratio of more than 1 in 2015, 2000 to 2018. However, in 2019, it displays a ratio of less than 1. But the company of Panasonic is less than 1 from 2015 until 2019. It shows that the company of Kin may be holding so much cash in hand, and the company of is not secure, and it could face short-term trouble paying off their debt as the company relies on the inventory that may not be quickly turned into cash. Okay, for the profitability ratio, actually, it is the most important thing for a firm because it is used to describe the company's bottom line, and it's written to its shareholders or investors, and it was illustrate business productivity and performance. Because this is very valuable to investors, because they tend to see the company's profitability ratio, because they plan to invest in order to determine whether or not the company is worth investing. Okay, in profitability ratio, we can see the gross profit ratio and net profit ratio. Okay, let me see the gross profit ratio first. Actually, if higher gross profit ratio, it will implies that the company can make a reasonable sales profit, and this is ensuring that its overhead costs are in control. Investors are generally concerned as a percentage of gross profit, as it's enable them to compare margins between companies regardless of their size or sales volume. The latter company is better than the other one by comparing Panasonic and Kin, because it has a higher ratio. Okay, the higher ratio actually obtain a reasonable profit on sales are being produced. Actually, the company is overperforming, and however, the Panasonic has a lower ratio and it is underperforming. Last but not least, for my part, net profit ratio. Okay, for the Kin company, which has a higher net profit margin, prove that it is a better company than Panasonic by contrasting both Panasonic and Kin. Okay, the Kin ratio is higher since it's more successful in controlling the company's expenses. Panasonic obtains a lower ratio since it's less competitive than Kin in management. In reality, Panasonic has lower net profit ratio because expenses are too high in this company. Okay, that's all from me. Thank you.
Hello, I'm Tiffany and I will present for activity ratio between Panasonic and Kin, which is based on the total inventory turnover ratio. So, based on that data, Panasonic more than greater. And then we know that the Panasonic was create the high revenue and selling their product very quickly if compared to Kin. This is because based on the result, Kin need to improve their inventory management. This is show the Kin is overstocking and overestimate their customer demand. Secondly, we can see that for inventory holding period, Panasonic also is better than Kin because of inventory for Panasonic are sold and replaced very faster, and they not holding the inventory not too long. So based on that, for inventory holding, I really show the shorter inventory holding period, the higher sale. Then the shorter day of inventory holding period, the more of an inventory turnover or replace. Last but not least, inventory holding period for Kin is more longer than Panasonic. This is because can make the revenue of Kin based on the data, but revenue for Panasonic is smaller than Kin in year 2019. Moreover, Panasonic need to raise their revenue and doing more promotion activity in the right time and offer more discount. We know that based on the data, Kin also get the higher revenue because of their longer inventory that holding period overcome to the high cost purchasing and stocking inventory. That's all for my and thank you.
In the conclusions, based on the common size balance sheet, can have the higher percentage of the long-term debt, which are between 10% to 13% for the consecutive 5 year compared to Panasonic, which have between 4% to 10% for the consecutive 5 year. From the liquidity ratio, Kin has a higher current ratio and a quick ratio than Panasonic. From the profitability ratio, Kin shows a higher result in the gross profit ratio and the net profit ratio. Lastly, from the activity ratio, Kin has a higher inventory turnover ratio and a longer holding period. Overall, we can conclude that Kin's performance is better than Panasonic because the liquidity and profitability ratio of the company is more important because a higher liquidity ratio and a higher profitability ratio can boost the reputations of the company and increase the trustworthiness of the company.